March 4th, year 2024. Many of you are concerned whether you should invest in RRSP. It depends on your income, your tax credits, especially non-refundable and refundable tax credits that you receive from CRA. Some tax credits you can carry forward, some expires within certain time limits. So in our example, we have two examples. In example 1, I'm going to show you the annual salary with $72,000. Now, obviously, by looking at the salary, we know this individual is in marginal tax bracket number 2 or tax bracket number 2. So, Mr. Blake, let's call him Mr. Sinnott. Mr. Blake Sinnott was born in 1970 in his 50s. Earns about $72,000 annual. Tax paid $12,900. EI premium paid $1,000. CPP premium paid is $3,700. Should he contribute to RRSP? Let's find out. So for this demonstration, I'm going to use two softwares. One, Profile Tax Softwares, and two, UFile. So for Mr. Blake, I'm going to use UFile software because it is user-friendly. You could easily understand. The profile software is usually used by the accountants or tax preparers for T1, T2, T3 for complex returns. UFile is an excellent software. It is very user-friendly. It is an excellent software even for the accountants who only practice for the personal tax return. Who only prepares personal tax returns. So for this scenario, in example 1, let's go to our UFile. We have Mr. Blake Sinnott here. That's his identification. We went through these CRA questions, any questions that I went through that. And then UFile requirements, if he does qualify for it. Whether he does or not depends on the situation he's in. This is the T4. This is the interview question that so this is the interview setup that UFile uses to ask certain questions. I won't get into that, the tax preparation detail, but rather show you the RRSP contributions and how it affects it. Okay, so this is the T4 income for this particular gentleman. We have $72,000 salaried income, and we have $3,700 CPP contribution, $1,000 EI premium contribution, and income tax deducted is $12,900. Let's go to his RRSP. He would qualify. Let's assume that he has $12,900 RRSP deductions limit for the year 2023, and so this is the form. He didn't contribute. Let's assume that in scenario 1, let's assume he did not contribute. Okay, in scenario 1, let's look at his tax return. He would get only $38.36 refund. Click on the federal tax summary, which I prepared for you to take a look at it. And you can see this is his non-refundable tax credit. So he fully used out his non-refundable tax credit. Okay. And this is the balance that he would receive as a payment from CRA. Now let's go back to the RRSP contributions. We're going to assume that he would contribute entire $12,900 into his RRSP or to his RRSP. So we're going to say, now beware. You can see that the software asks whether from March to December 2023, whether he has any contribution. It is always a good idea to contribute prior to December 2023. Okay. So let's assume that we contribute $12,900 from March to December 2023. And what would that trigger? Let's take a look at that. He would get $3,786 refund. So now in here, I also showed you let's assume that he didn't contribute from March to December 2023, he went to contribute in the first 60 days from January to February 28th or 29th for this year. He contributed the entire amount. What happens to that? You can see he still gets $3,786 refund. Now this might change, right? CRA would do an assessment and they would tell you by sending you a notice of assessment whether, how much would be your actual refund. But this is very almost near, very accurate if you provided all the information to the accountant or tax preparer accurate. So you know that it depends. It's a good idea. It's a good idea to autofill your tax return. So on your e-file questions, you see it asks you here whether you want to autofile. Okay? And so the accountant has to receive an authorization to do an e-file, and also he need your consent to download or obtain this information from CRA. So you'd read this and you'd click on that. Okay, so we don't want to get into that because I already prepared this for you, so we don't need to. So you just simply say no. And for now, you can see that with RRSP contribution, you get $3,786. Without the RRSP contribution, he would receive only $38, if I'm not mistaken. Let's go through that again. If we don't contribute that, and you'd see that he only receives $38.36 return. Okay, now you might have other credits like so let's say if we go to the interview setup, you might have investment income, you might have rental property, you might have pension income, you might have rental property income, you might have investment income, you might have capital gain, capital losses, you might have you might be some individuals might be self-employed, and you might have some education tax credit throughout the year. You might have RRSP, which in this case we demonstrated that. You probably paid alimony, you probably paid childcare, expenses, um, and all the other stuff. So it is a good idea to go to an accountant or financial planner who has both the accounting designation or accounting education and financial planning education. Very important. And they have, if they're a lawyer or paralegal, that's even better, right? So they would provide you the tax preparation, they provide you financial planning, they provide you with the legal planning as well. Now, with these three background, they can provide you advice that matters, right? Because you could really count on that advice. They can help you plan it effectively so you don't trigger any tax avoidance or tax evasion. There are a fine line between tax planning, tax avoidance, and tax evasion. So let's go to our second example. So this is our second example, Miss Anand Gibbs. Her birth year is 1999. She earns about $60,000, and tax paid was $9,458. She paid a EI premium $978, CPP premium $3,361.80. Question is, should she contribute to RRSP? What do you think? What do you think? Should she or should she not? So let's find out. So for this one, I used profile. So let's go to profile. Okay, so this is our information, and this is a T4 that I already prepared it earlier. These are $60,000 income, yeah, CPP, EI, and tax she paid. And these are ONBN, which is the Ontario tax credit. And you can see I already filled out for you. So she lives at the 21 Monk Street. I could have found something else better, but anyway, 21 Monk Street, and she paid about $18,000, $18,000 in rent. Okay, so, and I could see that her T1 right there. You can see at the end that she would, right there at the bottom of the screen, where I'm showing the cursor right there, 28 cents. That's what she get back. Okay, so right there in line 167, you can see right there, she would receive a refund of 28 cents. Okay, and again, if you use profile, so you could properly identify. She may have dependent. She might have some carry forward from previous years. And what I mean by that is she might have some unused tax credits from tuition expenses or other areas. She has tax slips, various kind, investments, employment, pensions, and then she has an income. Now, this is usually used for the self-employment individuals. So let's assume that she doesn't, okay? So she would fill out a T2125, and then she would also have deductions like, you can see, if she had, allowable business investment loss or net cumulative investment loss, or any other kind, okay? Or she might have unemployment expenses that she can deduct, okay? Capital gain loss, all kind of things that you could see it here. Now, with profile, one of the interesting thing is that you could search it right here, okay? Or you could go search over here. So in this case, also, let's assume that if she had world income from another part, we'd fill out our statement of world income, another part, another country. So I'm going to close this form. We don't need that. Okay, so now what I'm going to bring up the RRSP. Okay, so I'm going to, now without the RRSP contribution, she only gets 28 cents. Let's assume she made 5,000 RRSP contributions without checking the fact. You can see she gets no refund. You can click one right there, again, on the T1, and you can see nothing changed. Nothing changed. Okay, nothing changed whatsoever. Go back to our RSP. We change that to 10,000. You can see at the bottom of the screen without going into T1. At the bottom of the screen, you can see that nothing has changed. It's still 28 cents. A refund. Okay. Now this is using profile. Okay. Now again, I mentioned that earlier to you. Profile is designed for accountants or financial planner who has both accounting and financial planning background. Okay. And you could find all sorts of it could be really you could plan well by using profile because it allows you to do T1, T2, and T3, all three. Okay. So now you get the idea. If you contributed to $10,000 into RRSP or $5,000 without checking this, because it makes no difference in this scenario. Okay, so let's do a check. So for your curiosity, see how accurate this software calculation is. So I've decided the same amount from Miss Anand, from Miss Anand, the example 2. I used the same for Mr. Blake. I inputted that into that tax software in U-file. You can see this is for, I changed that. You know what? Let's not confuse you. The accuracy is correct in both software because I checked it in both profile and U-file with respect to by entering the information that is found on information is provided for Ms. Gibbs into the U-file as well. So without the contribution, she receives 28 cents. And with the RRSP contributions, she still receives 28 cents. So, refund. So the interesting fact is that if she contribute to medical, then she would get, so let's say if she contributed to, if she incurred $3,000 medical expense, she would get about $245 in tax credit. Let's see if I'm correct. Let's check. So this is the medical expense. Let's assume that she triggered. Let's assume. Oops, that's the wrong one. So let's assume that she can, she triggered in 2023 in June, in June 30th, she triggered. Let's assume that name of the patient is Miss Anand. And the payment is made to, let's say, Dental Inc. Okay? And so let's say clinic, just for, oops, it's a regular checkup. Okay? So if we do a regular checkup for $1,000, she still doesn't get anything. You can see at the bottom of the screen. But if you change that to 3,000, it changes. She would receive $244 credit around there. Okay, so these are very important. You would have to plan ahead how much, because $245 is not a small money. It's a lot of money in a country like, another country like Africa or third world. $245 is a lot of money. Um, it's probably person entire month's salary, or some cases entire year's salary in some areas, some countries. So we live in Canada. We are fortunate. So it's a good idea to plan well. Okay, you have various tax credits. You want to make sure that they utilize all of your tax credits, non-refundable and refundable tax credits, ahead of time prior to contributing to RRSP. It's a wise idea to contribute within the tax year. You can contribute in January, February as well, but it's a good idea to contribute, plan it ahead of time, because you could get dollar value for your money, okay? So if you get into a pack, you contribute $1,000 a month, it puts you in a better situation, okay? So I'm not going to give you, planning advice, but rather show you the tax preparation from the accounting perspectives, how the tax preparer or the accountant would advise you how much you need to contribute in each year. If you have an annual salary fixed amount, so you know you could contribute based on the previous year earnings. But if you don't have it, then you need to plan it well. Okay? Once again, this is Mijanur, and if you have any questions, you can comment below. And feel free to read my book, Financial Freedom, A Fictional Financial Plan. The link is here. This is Mijanur Rahman.